This session is going to be about how to access capital and how to fund your business. So we have a nice panel today that they represent different aspects of that. Each of us come from a little different perspective, and we hope that we're going to be able to give you some ideas that might fit your needs. My name's Jeff Taylor. I'm a vice president at First National Bank, so I represent commercial lending. I've been in banking for over 40 years and primarily in commercial lending. So that sometimes it's called business banking, but that would be what you would want to access at a local bank. So I'm going to let the other panelists introduce themselves. Erika?
Hello, everyone. My name is Erika Hersh. I am the Business Development Officer for LiftFund. LiftFund is what's called a CDFI. It's Community Development Financial Institution. And really what that means is we are mission-based lenders. We're a nonprofit organization. We are not a bank. We only do business lending and business education. We do those smaller loan amounts. $45,000 is our average loan size. So lots of those micro deals, and we're here to help you.
Paul? Hi guys, how you doing? My name is Paul Rodriguez. I'm a banker by trade, I guess. I was a banker for a long time here in Wichita Falls. And for today's purposes, I do several different things on a daily basis, but for today's purposes, I represent private equity funding.
Randy?
Hello, my name's Randy Brewster. I've been in banking for 20 years. Paul and I worked together for several years. I'm at Texoma Community Credit Union. Been there for about 6 years when Texoma decided to dive into commercial lending. We are now a full-blown dedicated commercial lender. And like I said, we've been doing this for 6 years. So I've got a banking, regular banking background as well as credit union.
Thank you. What we're going to do is a series of questions that we think you guys would want to have answered. And we're going to start at the very fundamental question, which is, what are options for sources of business loans? Business loans is one form of capital that most businesses need to access. Certainly, and we're not going to get into this today, but investors is a primary source, and you need to have some funding going into your business. Usually what you'll find is that lenders do not want to make you a loan if you don't have what we call skin in the game, if you don't have equity in your business. So there needs to be a starting point with a certain amount of capital that you've raised or that you've put in yourself, and then you would go to a lender. Now, I obviously represent the banking segment, and banking is probably one of the most common sources of capital via loans. Banks are readily available. There's numerous banks in every community, but what you'll find is that they all have a different personality. They all have a different focus. It's not one size fits all. So the first thing you need to recognize is that you need to find, if you're interested in obtaining a loan, you need to find a bank that fits what your needs are, that they make the type of loan that you're looking for. Every bank has a little different focus. Some like to make strictly commercial owner-occupied real estate loans, for instance. Maybe that's what they prefer. Some banks are real heavy into single-family residential, and they'll do that for investors. Others will get into commercial and industrial loans where you're buying equipment, and they'll make loans for long-term equipment purchases, or maybe they'll do inventory and accounts receivable. But not all banks are comfortable with all of those types of loans. So it behooves you to find a bank that's comfortable making the kind of loan that you need. One of the advantages of a bank is our rates tend to be reasonable. They're not the lowest, but they're not super high. They're going to be reasonable rates, but the process is a little bit restrictive in that we don't like startups. Banks, and I've worked for lots of commercial banks, they tend to like to see a proven source of repayment. So if you're a startup, you don't have that from your business. Now, you may have it from another source, and that's okay. For instance, if you're a high-income earner and you have another source of income that can support the loan that you are asking for, we wouldn't necessarily need it to come from your business. But if you're a startup and you're going to be relying solely on that startup, then typically the bank wants to see a couple of years of earnings. So we consider you a startup for the first 2 years. So that's one of the negatives, I guess, in terms of going to a bank if you're a startup, is that you're not going to have a lot of receptiveness there if you don't have another source. Another advantage of a bank, though, is it provides a lot of resources. You know, Erika was saying that all they do is make loans. Well, they don't take deposits, I guess. They're not going to be able to provide you with a checking account and all of those kinds of cash management services that a bank would have to offer. So they're all intertwined. So that's kind of, in a nutshell, what you're looking at from a bank standpoint as a source. So Erika, why don't you tell us a little more about microlending?
Sure. Thank you so much for that explanation. It really is a good start, because I tell business owners, go to a bank first. Start that relationship with a bank. You're going to get better terms, better products, better rates at a bank. But a bank sometimes has to say no. They don't, like Jeff said, they don't do startups, or maybe they don't like to do smaller loan amounts. Maybe it's a risky industry. Maybe it's just that's just not their appetite. And so that's where LiftFund comes in. We're in your back pocket to help you get that startup funding that you need, or maybe we do existing business funding as well. And so maybe you don't have the owner's equity injection that a bank wants, or maybe you're lacking in collateral. We have probably about 10 different products that we use. Some of those are internal products where we do have to have collateral, some collateral, not necessarily 100%. And then we have SBA products, so Small Business Administration. We are part of the 7A loan program, and we do loans up to $350,000. And then we have a micro loan program that goes up to $50,000. And our highest interest rate is 12.5%, so it is a little bit higher than a bank, but we take on that extra risk.
Okay, I'm going to skip down to Randy. Randy kind of falls in the same category as a bank with the credit unions. It's very similar, and it's kind of in the same bucket, but there are differences in how credit unions operate. So Randy, why don't you talk about that?
Well, as far as from a lending standpoint, really we're the same. Jeff pointed out that each institution has a desire, appetite, or whatever for loans. For example, they and many banks do not like typical startups. At Texoma Credit Union, do we do startups? Yes. You will need a business plan, so you'll need to go to the SBA, and they will help guide and walk you through it. Will they do the business plan for you? No. But will they show you how to do it? Yes, and it's worth every bit of it. Anywhere you go, typically, you're going to need a business plan. The other, I guess, some of the differences is, for example, with us, our rate is typically lower than a bank. We're using our members' money for the lending. So typically, not always, but it can be lower with us. When we started this about 6 years ago, our board noticed that small business owners like you guys were being overlooked and not really taken care of in the community. So that was the sole purpose of really me coming there, starting the department, and getting to where we are now. Again, I've been there for 6 years, well, just over 6 years now, and I personally have brought over $50 million of loans, and all that is here local in our economy. So I have a big pipeline. We do a lot, and again, we do most everything. One of the things we really don't do would be, unfortunately, a restaurant and or bar. Not to say that we won't, but we haven't, and that's a hard loan to get. Startups are also hard, but do we do startups? Yes, but we're also not a collateral-based lender as well as banks. you got a cash flow. We can look at projections, and if it's a new business, we look at just your total global cash flow. We look at all your debts, all your income, and we look at it that way. And I know banks do that as well. But, just because you're a startup and you're looking for a loan, there's places for you. But again, utilize our SBA here, our SBDC. Dan over there and Vanda, they've got a wealth of knowledge. They're here to help. And if you haven't gone to them, I highly encourage you to go to them.
So Randy, you alluded to this, but I think it's helpful for everyone to know that credit unions traditionally have not been engaged in commercial lending, business lending. I'd say it probably started 10 or 15 years ago, and you started it. They brought you in to start it at Texoma Community Credit Union. So the point being that they're going to be a little more restrictive. They may not have as many products. Do y'all have like a cap on how big of a loan you would even entertain?
Yes, we do. Our cap basically right now, it's really for loan relationship or single loan, but pretty much the maximum we can do per relationship is $4 million. So for most small business owners, you fall within that realm. But there's some other businesses that may need a $5, $6, $7+ million loan. I can't touch that. That's where the bigger banks come into play. But for most small business, a credit union should be able to take care of your needs.
Okay, so let's say you aren't eligible for financing from a bank or a credit union, and you've kind of exhausted those types of loans. So then you could go to the private equity funder. So Paul, tell us how that works.
All right, that saved me for last because I'm the cowboy up here. So I've worked with both Randy and Jeff at different banks here in town. So banker traditionally over the years, for the last actually 20 years or so, I now play with one of my friends. His name's Gary Meehan. So to put it in a nutshell, we do deals that bankers consider non-bankable deals. So first of all, relationships are super important. Relationships with the community bank is super important. That's what these guys do on a daily basis. So I would, again, first of all, always recommend somebody to go talk to a bank, talk to a local credit union here in town, but build those relationships and see what those guys can do for you. So I can use my 20 years of banking experience and look at a deal today and make a decision today without having to go through some of the things that Jeff and Randy have to go through. So I don't have a loan committee to go to. I don't have a board to go to. Me and Gary make the decisions on our own. We do, again, me being the cowboy now, so we do a little bit of everything. So our smallest loan that we have on the books right now probably is about $5,000. Our largest loan that we have on the books today is about $2.2 million. So you guys can see that what I'm trying to do is use my, I guess, Rolodex of customers that I've had over the last 20 years and continue that on with what I'm doing today. So when someone goes to a bank, they're looking for capital. They're looking to get their business going. They're looking to continue their business. They're looking to grow their business. And a lot of times those deals just aren't able to get done. And so when those deals aren't able to get done, then that's when people look for private equity money. This is what we do, again, on a daily basis. So that's kind of it in a nutshell. There's a lot of stuff, a lot of moving parts going on with what I do, but that kind of covers it in a nutshell.
Thank you. I want to circle back on something that Erika brought up, and that was SBA loans, and Randy also alluded to the SBA. SBA is a resource. It's a tool. It's a very good one, especially for small businesses and startups, because there's two different primary programs that they have. One's called the 7A program, and that is where the government comes in and would guarantee the loan. They don't guarantee 100% of the loan, but they'll guarantee some percentage of it, so maybe 80%, maybe 75%. When a bank sees an SBA guarantee on the loan, they're more willing to make it. So for instance, if you're a startup and you don't, maybe you're relying, you submitted the loan request based on projections. You don't have a history of actual cash flow. The SBA will approve that sometimes, and the bank will go, okay, well, if the SBA is going to guarantee it, then we'll make the loan, because the bank makes the loan. But they need to be willing to sponsor it with the SBA. And there's a whole process there. Some banks do a lot of SBA loans, and they're called certified lenders, and they can make the decision right there. Others, they will make sure it meets their requirements, and then they will submit it down to the SBA, and the SBA will approve it. So that's a very good source of funding. The three primary things that it helps with is startups, because like I said, the SBA will allow you to work up projections, very detailed. They're going to want to know month to month in the first year, and then they're going to want like 2 more years thereafter. And they're going to want to know what all your premises are, that you used for your projections. So whereas a bank is going to say, well, we can't even look at it, SBA will allow you to at least get in the door. Doesn't mean it's automatically approved, but it gives you a shot. The second thing is their terms tend to be slightly more liberal, whereas a bank might say the maximum repayment period we would do is 20 or 25 years. The SBA may go, well, we'll do 25 or 30. And of course that helps your cash flow because your loan payment would be smaller. And then finally, collateral, at least this is my experience, Erika, you tell me, I haven't done an SBA loan in a long time, but back when I was doing them, collateral was the lowest thing on their priority list. If everything else is good and you're a little short on your collateral, they'll still approve it sometimes. Now, if you have other weaknesses and your collateral's short, that might kick you out. But if you're running short on collateral, but otherwise you've got a really good loan, well, SBA 7A loan is a good option to help you get over that hump. There's another program called 504, and it's different in that the bank makes, so let's say your project, 100% of your project, maybe you're buying an owner-occupied property or something. Typically a bank's going to want 20-25% down. And you're like, I don't have that much equity to put in it. So under this program, you might have to put as little down as 10%, or maybe 15 if it's a special purpose facility. And you put in your 10 or 15, the bank puts in 50% on a first lien note, and it's direct with the bank, and then the SBA comes in and makes you a direct loan for the other 35 or 40%. And that's subordinated to the bank. So the bank's willing to go ahead and do it even though you don't have as much collateral, because its risk is mitigated by doing a 50% loan. Now, I will tell you, those are difficult loans. The process is just painful, but it's worth it sometimes. So be aware that the SBA is a resource, but it's kind of an overlay. It's not, you don't go direct to the SBA and get your loan. Do you want to add anything to that?
I think the only thing that I would add to that about the 504 program is the SBA partners with, they're called CDCs, Community Development Centers or corporations. And so LiftFund is one of those CDCs. So we would come in and do that other 35%. The rates on the 504 program are much lower. It's a fixed rate. But you're right, Jeff. It takes months and months and months to get done. It's usually for maybe you want to buy some land, construct a building, you want to buy a building, you want to do some improvements, you want to buy a large car wash piece of equipment. So it's really large deals that don't have to be done in a quick, timely manner.
Yeah, I'd say if it's less than $700,000-800,000, you wouldn't even want to consider going that direction. It's just not worth it. Now, she mentioned the rates. Rates in general with SBA loans on 7A are pretty much similar to what you would get with a bank. The bank sets those rates. With the 504, the bank's portion would be a typical rate, but the debenture that funds the SBA's piece of that, that's a tremendous rate. It'll be really great low rate, and it'll be fixed for the full term. I mean, for the full amortization. Whereas the bank, they might do a 10-year, I think they have to do at least a 10-year term on those. But man, if you can lock in a great long-term rate on that second lien note, that can be a tremendous advantage to you. So keep that in the back of your mind. So those are your sources of possible loans where you could go to get them. As Erika said, you should start with the bank, and I think it's always a good idea to develop a relationship with the bank. Because if a bank knows you and has dealings with you and they have your deposits and you can go in, and that's one of the advantages to a bank. You can go in face to face, you can talk to your lender, he can walk you through, the process, he can give you some suggestions on how you might approach what you're trying to do. There's usually more than one way to skin a cat, so they're a good resource for that. So find you a bank that can be your partner. But what you don't want to expect, you want to manage your expectations. They're not your partner in the sense that they're taking risk in your deal. If they make a loan, they want to make sure that there's going to be, the repayment's almost guaranteed. And you might look at that as a negative, but that's just what you're looking at when you're dealing with a bank. So what is needed to get a loan? Let's get into that. When you go into the bank, you want to be prepared. So I'm going to pitch that over to Paul. Paul, why don't you talk about what people should be prepared to bring to a bank?
Financials. So that's kind of the reason that what I do today is a little bit easier in regards to some of the expectations that comes with the bank. We talk about startups. We talk about someone who's been in business for a long time. The financial aspect of what is required from a bank or a credit union from these guys sometimes seems like overwhelming a lot of times. So I say that when someone starts a business, you really got to have capital, right? You got to have a bank, you got to have a CPA, you have had an attorney as well. You got to have a good team to get going. If you don't have those things in line, then things usually don't work well. So having a CPA that's able to prepare those things for you is super important. And there's different levels, right? You can start off with the bookkeeper and then kind of move up from there. But when someone starts a small business, I'm going to talk about Ruben real quick because Ruben's in the audience today. Ruben was a customer of mine at the bank for a long time. We talk about staying in your lane, so Ruben can attest to this. I preached this to Ruben for a long time, but I'm just going to pick on him for a little bit. But it's super important that everybody stays in their lane with what they're doing with their job. Job being, in his case, his passion, his love. Let's keep Ruben focused on what he likes to do, what he loves to do, and what he's good at. Everybody has their job, so if the CPA is good at crunching numbers every day, that's what he likes to do, let him do that. Let him do that for you. And I promise you that's going to make you more successful. So I think that a lot of times people go to a bank, they say, whether it's Brewster or Jeff says, here's a list, here's a piece of paper, bring me all these things back. And a lot of times it's just overwhelming. So for us as or bankers, I'm going to say bankers, it's normal stuff, right? We ask for a P&L, we ask for a balance sheet, we ask for a tax return, we want a personal financial statement. We ask for all these things. For us, it's super easy, right? Because that's what we do for a living. That's what we do every day. But in reality, I think it's super important that you guys, as small business owners, you get your stuff together, for lack of a better term. You get it together, but you have people in your camp, on your team, that you can count on. And sometimes those guys, I said CPA, bookkeeper, but even a friend. Maybe you might know somebody that has done some or had a business before and knows how to keep books on their own. So maybe you start off with somebody like that that says, I'm trying to start this new business, but I need somebody to help me out to do that. So anyway, I think for me, most importantly, it's having somebody in your camp that knows what those things are. Let you focus on what your business is, your passion is, and then let somebody else take care of those other things for you.
Well, and another way to say that is that people, when they start a business, usually they have a passion for what they're doing. They have experience with it. They know how to do it. They have those skill sets. And so that's where they want to spend their time. That's a different thing from having skill sets to run a business. And so they don't realize that. They think they can do it. And next thing you know, they're not giving enough attention to the actual running of the business. They're focused on working in the business. And time again, we've seen that that's a big mistake because then they let things go.
Let's go back. So one of my analogies that I use all the time from years of banking, everybody thinks that restaurants fail because restaurants fail, because they're a startup or because it's a restaurant. So I've banked several restaurants over the years that have been super successful, that are successful today. I still bank guys that are restaurant guys. So it's not about a restaurant failing, it's about the team that you put together for that restaurant. So you can have the best, I'm not gonna say hamburgers because we're in a bad pickle with hamburger guys right now, but say a brisket. You can make the best brisket in Wichita Falls, but be a crappy business owner and fail. You can have the crappiest brisket in Wichita Falls and have a hell of a team that's out of this world, that's tremendous, and be successful. So that's the difference. It's not about necessarily just having the best brisket in town. It's about having a team together that makes you successful. And so I promise you, because I've seen it before, I've been a part of it before, I've been a part of those teams, I'm still a part of those teams today, that you surround yourself with good people, right? And good things are going to happen and you're going to be successful.
Randy, do you have anything to add with what they need to provide for an application?
Well, really the same for all us bankers. I mean, again, we're going to need 3 years tax returns, a PFS, personal financial statement, balance sheet, profit and loss, business debt schedule, and stuff like that. That's just standard across the industry. One thing I want to encourage each of y'all out there is, unfortunately, sometimes you don't want to pay taxes, and you get with your accountant and you go, I don't want to pay taxes, so do what you got to do. Well, guess what? When you come to us for a loan and you can't prove that income, we can't do it because it's changed. We have to prove your income. We prove your income with your tax return. I've banked several people that they've come to me. I know them. I know their business. But when I did their spreads and looked at it, you don't flow. I can't do it. I can't prove your loan. Well, but you know I've got this. I do, but I can't prove it. Well, but I've got all this extra collateral. Well, that's great, but we're not necessarily a collateral lender. There are collateral lenders out there, but I don't really know of one in Wichita Falls from a financial institution. Paul, on the other hand, could be more of a collateral-based lender than Jeff and I, but that's just how it is. So if I can give you I know you don't want to pay taxes, and I get that, and I understand that, but you have to be able to show your income, because there's nothing worse than telling somebody no, and I know I can speak from everybody up here. The last thing we want to do is to set you up to fail. If you fail, we fail. We don't want that. You don't want that.
Erika, how does that differ from what you need?
Yeah, I think I would like to add that the loans with us are in the business name. It's a business loan, but each loan has something called a personal guarantee attached to it. So we are going to pull your personal credit. We're going to check the personal credit. For us, we have a tiered system where you can get up to $10,000 with a 550 credit score, up to $40,000 with a 600 score, and anything over $40,000, we want a 650 and above. It's not just the score itself that's important. We're going to look at the actual report. We want to make sure all your payments have been made on time in the last 6 months, that there's no bankruptcies, active collections in the past 2 years. But just know that that's going to be a question that I ask if we have a conversation. Do you know your personal credit score? Has everything been paid on time?
So one last thing with what you need to provide, if you are providing collateral, we do need some detailed information about that collateral. Don't just come in there and go, well, I've got a bunch of tractors or, some cars. We need to know what they are. We need their VIN numbers. We need to have a sense of what their value is. Sometimes we'll try to confirm that online or something. If it's real estate, depending on the size of the loan, we may require an appraisal. At First National, if it's under $100,000, we'll try to do what we call an in-house valuation to save you that money. But we're going to have a pretty good assessment of its value before we would lend against it. So be prepared to provide that kind of information on your collateral. How important is your credit score? Well, we're talking about business loans here. So we're primarily concerned about the business's ability to repay the loan. But every bank I've ever known requires personal guarantees of anybody that owns 20% or more of the business. And we're going to want financial statements on them, we're going to want tax returns on them, and we're going to pull their credit. If they all have bad credit, then that's not a good sign that the company's going to do a good job repaying its bills. So that's where the credit score comes in. It's an indicator. Now, sometimes that can be explained away, sometimes it can't, but just be aware that that is an important issue. Anybody have anything to add there?
I grew up in consumer lending, so I looked at credit a lot. Where I first came from was Citi, and when I learned how to read credit, I wasn't even able to look at credit scores. So I was able to only to look at trade lines. And so when you're only able to look at trade lines and make a decision based off of trade lines and not a score, you learn how to read credit really, really good, and you have to do that to make a decision on a loan. So credit bureaus, looking at those deals over the last 20 plus years, has been a big part of my life. When I was at First Bank, I guess I was the credit guy at First Bank, so everybody would call me and ask me about credit. Why is this or why is that? And so you talk about credit scores being an indicator. What really, people think that credit scores are what's happening today. But really what credit bureaus are trying to do is they're trying to forecast what's going to happen in the future. It's really what they're trying to do. And so if someone comes in today and you have, a 650, why does a bank care what that number is? Does it care what the number is today? It does because of past history, but it's also trying to forecast what's going to happen. If I'm going to do a loan for 24 months or 36 months, I'm trying to figure out what the heck these guys are going to do, what they're looking like in the next 24 to 36 months. So one of the huge indicators for that would be capacity. So there's different C's for credit, but capacity to me is probably the most important one. So what that basically means is like your debt to income ratio, basically. So if you have a credit, for easy numbers, if you have a credit card that has a limit of $1,000 on it and you owe $1,000 on it, you're maxed out, right? You're to the hill. So if you have a credit card that's $1,000 limit and you owe, I think the number today is probably 40% or below, it's going to help your credit score. So what it's trying to tell you though is your score is going to be a lot lower if your capacity is maxed out. And so again, what it's trying to do is tell you what's going to happen in the future. So what the advice credit-wise, just real quick-wise, would be try to figure out when you're in the need of credit. And at that credit today, if you're not buying a house, you're not buying a car, you're not out trying to open up a new credit card, who cares what your credit score is? What you're trying to do is maximize your credit score at the point of you trying to obtain credit.
I'll kind of piggyback off that just a little bit, but more on the score. Again, as Jeff kind of alluded to, we all look at your personal credit. The kind of cutoff typically for that is 650. You need to be a 650 or higher is your typical cutoff score. I know that's pretty much for the SBA too. Some institutions have actually raised that to 700. We are at a baseline of 650, but that doesn't mean we're going to cut you off. There are some institutions where they just see that and they won't even talk to you. I've done them lower. I've even got one in the fives. So that's the difference with a community credit union is we look at all assets. You're not going to be an automatic denial, but it is very indicative of what could happen. So yes, it is a factor. The lower the credit score, the higher the risk, the higher the interest rate. So yes, credit is very important.
Erika, do you have anything to add?
The only thing I have to add is from the question before about what is needed, I forgot to mention that for us, if it's a loan that's $40,000 or under, we only collect bank statements and proof that you are an actual person in a business. If it's over $40,000, that's considered a larger loan, and it is very document heavy.
Okay, so another element of these personal guarantees and the credit score, the lender is going to look at what your personal needs are. They're not going to just run a credit evaluation on the business. They're going to do what's called a global cash flow analysis. So if you have a lot of obligations and you're going to have to be pulling a lot of money out of the business to live off of, we need to know that. So what we do is we look at all your obligations monthly. We look at what the projected obligations are for the company. We look at what your cash flow is overall. And then we run some ratios and such. And if you're having trouble paying your bills now, then that's a concern for us. So I just wanted to bring that up. Another thing I want to touch on before we get out of here is one of the number one most important factors in a business is having a sufficient working capital. and banks look at that. If you are running on a razor-thin margin and you don't have any kind of reserves, you don't have much in the bank, you don't have a lot of inventory, and you're just kind of hand-to-mouth every month, we're going to pick up on that because, as you all probably know, there's always going to be some kind of hiccup that you don't anticipate. And when that happens, you've got to have some reserves to cover that. So maybe you have a repair issue, or maybe there's a weather issue, and it interrupts your ability to operate for a while, and all of a sudden the cash is not coming in, and then the bank's sitting there going, well, hey, we still got to have our payment every month. So we want to know you have sufficient, and that's called working capital. Those are assets that are readily convertible to cash. And that's one of the number one things that takes down small businesses is not having enough working capital. So I know that's a little bit off the topic, but I wanted to bring it up, and it is important to us lenders when we're looking at your credit worthiness. So at this point, we've only got about 5 minutes left, and does anybody have any specific questions that you'd like to ask? Don't tell me we did that good a job.
Everybody's ready for lunch.
Or y'all are ready for lunch, aren't you? Okay. Well, I hope this was informative and helpful. And any of us, of course, are available to you if you want to ask any questions after the panel's over.